Welcome to readtheticker.com. Today we're going to talk about never pick a top ever. In the stock market, after a period of rising prices, you hope that the market will signal a top. Most common patterns are head and shoulders. You get a rise up, a shoulder, a head, you get a sell down, you get another shoulder. Triple top or a double top. The most important things about these patterns is that you see distribution at hand. And distribution takes time. This allows those who have accumulated at lower prices to sell to those who have not accumulated at higher prices. And understanding Wyckoff volume and price patterns, you can see where the selling is more heavy on the downswing or on the upswing, and you get a fair idea how strong or weak a distribution pattern is. So if you don't pick a top and you wait for the distribution, you have a fair idea when the market top is coming. If you do pick a top, it's most likely going to be too early and you're going to be out before you enjoy better market returns. Of course, nothing in the stock market is certain. A V reversal gives little forecast of a market turn. But hopefully V reversals remain rare, and they are most likely to occur after an extended blow-off period, a buying climax or a selling climax. This is when you've got days and many days of accelerating price advances without a bend, and the price has just been pumped up dramatically, and then they're just sold down dramatically. So if the statistic stays true that V reversals are rare, you should never pick a top and wait for a distribution patterns to give you an idea when the market top is about. Let's take a look around. Here we have the 2007 market top of the Dow Jones, and as you can see, at a swing up, swing down, swing up, swing down, swing up, and a swing down. So in this period here, those who understood Wyckoff distribution patterns and looking for studying the volume swing, it was this swing down here that was most vicious. The volume on the swing down here was much greater than any other swing of the volume on the swing up here or the swing up here. So people decided to sell at all-time highs. Here was I believe this time of year was January, and people took advantage of the sell down here. Just draw a line. Here we had our shoulder, head, shoulder, a break of the line, and then we had this rally up here, which was the rally of hope, but unfortunately it was not supported with volume, and eventually it was just sold into, and the volume down here was quite spectacular. As you can sort of see, there was time about, I think we've got here between April and January, so that's a good 6 months of distribution going on, and the investor had plenty of time to evaluate where the market top was been formed. And they even had a second chance. If they did not get out here and prices rallied up here, you had a fairly good chance of getting out here if you had not exited the market in this position around here. So you had plenty of time and opportunity to get out of the market. And so all those people with large accounts, especially the hedge funds and what have you, they had every chance in the world to exit the positions and even take short positions, because obviously this is a lower low. As I said here, this is a lower high, say, and a lower low. So to go short at these positions, at every opportunity. This is a well formed top, and it gave the investor plenty of time to study distribution patterns to work out what was going on. So if you consider what you've learned about 2007 and you review what's going on now, this is the Dow Jones moment. Now, the first telltale sign we've had is that this sell-off down here was substantial volume, more volume on down the upswing. So we're just beginning to see some distribution at these heights. That doesn't mean it can't go up here. Maybe we get a shoulder there. Oops, a shoulder. We get a head there. Anything's possible. But at the moment, folks have started to lighten their books and start some selling down here. So we could. So very interesting what happens if we get a sell-off down here. Watch the distribution if people take the opportunity to lighten their books and put some volume into the sell down. Now, obviously, in previous times, the market's not been so generous at tops. Here we have, what was this, 1987. A very strong rally up, of course, especially this one here. And really, investors had very little chance of getting out of the market at the top because there's very little distribution. Pretty much caught everyone here. So if you were picking your top and you're selling into this rally, you were most likely extremely lucky. So as I said, let's just hope V reversals are rare. That's 1987. That was about a, what was that, 20-30% drop in a short period of time? Okay. The other notable V reversal is the Dow Jones in the 1929 crash. As once before, we had rather extended rallies up and very little time at the top here to sort of see if any distribution was going on. Yes, we had a sell down here. Oops, drawing's not that great. Yes, we had a sell down here. But as market participants would have been hoping for a bounce and then another chance to sell down. But as you can imagine, there was really no chance at all to get out or study distribution patterns. So be warned when you get a blow-off acceleration into new highs. Unrelenting optimism. So let's just hope the V reversals are rare, and let's just hope we get some distribution patterns to allow us to determine whether a top in 2014 is occurring. So keep an eye on volume and price action on the swings, especially volume on the downswings within a consolidation pattern. Thanks for watching.